going to start a series on, investing, especially for beginners. Now, if you're a beginner, guys, it's good that you're here. I'm going to teach you as much as I can and try to cover as much as I can. So kind of going to start with how many types of investors there are. There are multiple types of investors. There are day traders, dividend capturers, swing traders, and long-term investors. So if you're new to investing, I do recommend you guys using Robinhood. Robinhood is a free stock trading application that allows you to trade stocks without any fees. It doesn't require a minimum deposit. You could actually have $5 in the account and still have the account. So that's why I really like it. Now, guys, if you're new to investing, you have to understand that there are, different kinds of investors. There are people that day trade. There are people that, swing trade. There are people that, long-term invest, like I am. I'm a long-term investor. I do day trade. But, those are different methods that I use in different portfolios. And then there are people that do dividend captures. And I'm going to talk about some of them, not get into depth, but kind of give you a brief explanation so this video won't be too long. Now, in Robinhood, you can't not day trade unless you have a $25,000 limit. If you have $25,000 in your account, then you can day trade. But I don't recommend it if you're a new investor, just because you don't know what you're doing yet. Eventually, you can jump into it, but I do recommend you guys start slow and get the market first before you do day trade. Now, what swing traders are, kind of going to explain over here. I'm going to explain with Ford real quick. Let's look at the week process. So what, let me give you an example. So what you try to do here with swing trading is that you try to buy at a low. So you start, let's say you start off Monday, you buy here, and then you're waiting for it to go up and sell here. And then when it drops again, you're going to buy, and then when you reach a certain peak, you're going to sell. It drops again, you buy, it goes up again, and you sell. And this happens within like a day's process. I mean, like 2 or 3 days. This is what you do throughout the week. That's what swing trading is. Day trading is a very, very similar process. But as you see, this was a week. Now this is a day. The way you do it in day trade is pretty much buying at a low point and selling at a high point. And this could happen within 5 minutes or so. So every time you go at a low point, you buy and then you sell at a high point. Now the way you do it in day trading is that you always find a baseline. So whenever it drops, when it usually drops, that's where you buy. It's eventually going to peak up, especially a stock like this that, jumps up and down a lot. But the way you kind of see it is that you try to find a base where to buy. So as you see here, there's always a pattern. Every time it drops down, you should buy around these areas and sell at these areas. So as you see, it has a pattern that it always has. As you see, these are places where you want to buy and these are places where you want to sell. And what day traders do here is that they, let's say, buy 100 stocks at this point and then they sell all those 100 stocks at that point. Or, there's different methods of doing it. And people have many methods of doing it. So that's pretty much what day trading is. Now, long-term investors, which I am a long-term investor,